How do you structure a joint venture deal? What's going on YouTube? It's Matt Faircloth. Thank you so much for watching Mentorship Monday. Mentorship Monday goes down like this. People email questions to helpme@DeRosaGroup.com. That is helpme@DeRosaGroup.com, and I'll answer them right here on the YouTube channel for you and everyone else to learn from. Like I said, my name is Matt. My company is the DeRosa Group. If you guys want to go out to DeRosaGroup.com and check out our website, sign up for our newsletter, hear what we're up to, check us out, and you guys can learn a lot more about what the DeRosa Group does as a company, besides answering your questions right here on the YouTube channel. Today's question comes from Jesse. Hi, Jesse. Jesse says, Matt, I bought and read your book on raising money. That's awesome. Great stuff there. I had a question for you on how to structure joint venture deals for both fix and flip and buy and hold. Well, we'll get back to that, Jesse, but you really shouldn't do joint ventures on buy and holds. That's just equity at that point. But let's get back to that one. Okay. For one small deals, it doesn't seem to make sense to do a whole LLC. That's correct. I know that you can't give legal advice. That's also correct, Jesse, that I am not an attorney, so this is not legal advice. This is just my personal opinion about things, and just an open discussion. But I wanted to see how you structured your JV deals in the past. Specifically, is the investor secured only through the JV agreement, or do you actually put them on title? Is there another way that they are secured? If you put them on title, how does that affect a hard money lender? Okay, thank you. You're welcome, Jesse. Here we go. So a joint venture works like this, and this is, you would do a joint venture in certain scenarios only. A joint venture is where you have someone who's lending you money per se, but you're also bringing them onto the ownership side of the property as well. This is a hybrid model between a loan and an equity deal. A loan is someone just lending you money at a flat interest rate with a rate of return on their money. So they loan you the money for 1 year, you pay them back their money, and they make 9% interest on their money, whatever it is, right? That's a loan, and that is secured with a lien on the property that they can execute and come and foreclose on the property if they want to. That's their collateral, is the lien on your property. That's a loan. Equity is where someone owns a chunk of the property alongside you, and so let's say that's a rental deal. And as rents continue to come in, they get a chunk of those rents. A percentage of profit that comes in that's made off the property on a monthly basis gets cut to them in an equity check. So if you have a rental property that makes $1,000 a month and your equity investor has 30% ownership, then you are going to cut them a check for $300, which is their chunk of the cash flow, not the rent, the cash flow of that property. So rent comes in, after all expenses are paid, they get a chunk of the cash flow. That is an equity deal. The joint venture model merges those two. It takes your lender and pays them a rate of return on their money, but also gives them a percentage of the profit on the deal. It does not make sense to do this in a rental deal, because if you're going to do it on a rental deal, you pretty much just got an equity investor, okay? The time that you see joint ventures show up is where someone is building like we did it where we built a bunch of townhouses in Philadelphia. We've done it where we've done a fix and flip, where we had a lender that stepped in and they lent us money on the project. And that loan was secured by the JV agreement. They did not get a lien on title, and I'll get back to that. But they got a rate of return on their money, plus they got a chunk of profit. For the deal in Philadelphia, we paid them, I think it was 8% on their money, plus 12% of profit. And the profit was, take the profit on sale, like the sell price, minus the construction cost, minus the carrying cost, minus all the expenses, everything, then you're left with a profit. They got 12% of that, okay? Plus a rate of return on their money of 8% annualized, okay? That is how a JV, that's what it is. Here's why you do a JV. A JV is done because you can't borrow the money from the lender. The lender, it's such two reasons, right? It's such a high risk project that the lender wants further compensation on their money. So let's say it's a enormous apartment building and somebody's going to loan you a bunch of money on it. Well, they're probably going to want a chunk of the upside as compensation for the risk. Because remember, as I've said before, profit or a rate of return on an investor's money is increased in the perceived risk that that investor thinks that they're taking. And so if the investor thinks that they're taking a lot more risk, they are going to want more of a rate of return from you, which is why you might see properties like a Walgreens on a triple net lease, which is a super low risk, might trade at a much lower cap rate and a much lower profit margin because it's way low risk. The Walgreens would have to go out of business for that lease to not pay up, right? Whereas a vacant apartment building that needs a ton of work is a perceived higher risk. Probably right about that. So that investor is going to want a higher rate of return than what you're going to be able to pay them in just a flat interest rate on their money. Now, they also want to ride along. They see that maybe you have a chance to make a big profit, so they're going to want to win alongside you in that. They might be flexible on their loan terms, might be able to give you a little more money towards the project if you structure it with a JV. Very few banks are going to be willing to do this. I've seen hard money lenders do joint venture deals, and I've seen, of course, private investors. If you read my book, Raising Private Capital, it talks about how to structure these types of deals with investors. And so your passive investor that's just loaning you money out of their IRA account will very likely be willing to do a JV if you show them the profit margins on the deal and what they could make if the deal hits. Okay, so that is why the JV, that's what it is. I covered why you can't do it why you should do it on a rental deal, because it just doesn't make sense. The next reason why you need to do a JV deal that I wanted to cover is that, let's say we're talking about the townhouses I built in Philadelphia. Okay, well, I wanted to borrow money from a bank to handle all that construction. So we went to a lender, and the lender said, okay, great, we'll loan you 50% of the purchase price of the land plus 80% of the construction cost. That amounted to like $750,000. But I needed another $290,000 to buy the land and to have some cash so I could advance contractors and keep the project moving. Okay, so I went to a private investor and I said, I want to borrow $290,000, but the problem is I can't give you a lien on the property. And I couldn't because the lender, the first position lender that was lending us that construction money, did not want to see another lien sitting behind us from another lender. And so I couldn't give the collateral of a lien to that second position lender. And so they, again, perceived risk. Well, I can't get a lien, and so I perceive more risk to be in this project. And so what are they going to do? They're going to ask us for a chunk of the upside of the project. And so that's why we had to do a JV, because they were willing to loan us the $290,000 with a rate of return on their money, but instead of the collateral of the lien on the property, they got a chunk of the upside, which is where the JV came in. So first position lender with a equity lender on a JV, okay, that came in behind them, okay. That's how that got structured. So I believe, let's see if I answer all your questions. JV, fix and flip. You don't want to do it on buy and hold, Jesse. I forbid you. Just bring in equity investors on a straight equity split and just do it on a buy and hold that way. Put them on title. You're not going to put them on title. They're only secured by the JV agreement and by the equity that's associated with the deal. So that's that. JV agreements are great ways to take on larger construction projects that have a little bit of hair on them, but you've got to structure them the right way. You got to position them the right way. You've got to put them in the right. You got to put them in the right position. Put them in the right properties, and don't use them on properties that it doesn't make sense, like longer term equity deals or longer term buy and hold projects and stuff like that. So JVs are great for fix and flips. They're great for BRRRR deals. If you're doing the BRRRR strategy on a project where you're going to refinance and get all the capital back, because maybe you can return all the investors' money to them, and then they maintain a small percent ownership of the project. So I would say, Jesse, you could do it on a rental deal, but only if you're going to refi and give the investor all their money back once you get to that refinance part of the BRRRR deal. That's it. Read my book for more on joint venture deals. They're a phenomenal way to do fix and flips and other big value creation projects overall. So, Jesse, thank you for your question. Thank you guys for watching. As always, I appreciate you guys checking us out on YouTube. And if you're not a subscriber, feel free to click the subscribe button down below so you can keep up with what we're up to here on the YouTube channel. Have a great, profitable week, guys.